Hi, in this video we are going to learn what should a defensive investor do and how should their portfolio look like and what are the policies. A defensive investor, to quickly recap, is a person who does not have a lot of time to do a lot of investment research or to spend a lot of time into stock market related activities, but has a limited time and wants to do his portfolio management almost in autopilot. So what should they do? They should invest 50% their money into stock and 50% into high grade bonds. So this was a new learning for me. So this ratio is again informed by this previous video that we learned around human psychology of misjudgment or miswanting. And so because of that susceptibility, it's very important for us to have a set of rules, a set of foundation which we stay constant throughout our investments life cycle. And so this is one of those rules that Benjamin Graham is advising. He's saying 50-50 if you are a defensive investor. So at no point that bond allocation should be less than 25% because he's seen many investors not invest during the time of low recession times or during the time when stock market goes down. And that's a problem. To get to empower people with the courage, I think 25% of bond portfolio gives them enough cushion to stay holding to their stock, but also buy more. So this is a very important learning. It's like the shopping cart list that we take with us and we adhere to that list and we don't buy things that are not needed. Similarly, if we have a 50-50 rule, we will rebalance every 6 months. So that's the second tip for a defensive portfolio investor. Every 6 months at the minimum, if not 3 months, you should rebalance. If your stocks do well than bonds, then sell stocks and rebalance and get bonds more and keep a little bit more cash. So lighten your stocks when the market advances and add more stocks when the market declines. It's a contradiction actually, and that's again we need to understand the psychology of human misjudgment. A lot of times people keep holding when the stock market goes up because they feel it's going to go up more. And so this is what causes the bull markets and the bear markets, because of extreme optimism and extreme pessimisms of human mind. So that psychology or that human nature is something that we need to be deeply aware of. We need to understand our psychology and we need to use tools that allow us to be not susceptible to the risks of human psychology and emotions and the intellect that we looked into the previous video. So rebalance is an important thing to do every 6 months. That was a very new thing. This rule was very new for me. This rebalancing principle was very new for me. If you feel the stock market is depressed, you can take the judgment and go to 75%. You could always increase that percentage, but do it as an exception. If possible, stick to the 50-50. You're going to be better off. And how much risk should a person take? Well, it depends on their ability, their financial capability, their future goals, etc. 100 minus the age is a good rule of thumb, but that's not the only way to assess if you should be investing 50% or less in the stock market. Depends on your goals. A lot of time we've seen that indexing in mutual funds or indexing through index funds is probably the best way for a defensive investor to gain exposure to the stock market. They have low cost funds. Bonds also have a very low cost, at least if they're high grade bonds. But there is a contradiction here because Warren Buffett every time he says that a typical investor is better off indexing and dollar cost averaging, but he typically never does that. He doesn't do that because of this bargain issue. He gets a lot of deals that are at very stressed levels and he need to put in cash very quickly. And if he has to move those cash very quickly, he will not be able to do it if he doesn't have that cash. So he goes to the preferred stock route, which is something that we should completely avoid as for most investors. So here's the example of rebalancing. In this, we see that a person has a $200,000 stock portfolio, $200,000 of portfolio, after which 50% is in stock, so 100,000 is in stock, 40% bonds, so 80,000 in bond, and 10% cash, so 20,000. So let's say 6 months from now, the stock actually goes up to 10% appreciation. So it becomes 110,000. In the bond, there is an increase of $1,000, but the cash, let's say, remains the same. So we see that in this situation, the person should be selling $4,500 of stock, buying bonds, and keeping some cash. So that gets the equation back to 50, 40, 10, or some ratio that you divide. So whenever the stock goes up, we should sell. Whenever the stock goes down, we should buy more of stock. And when both of them go down, you rebalance to get to the previous level of 50, 40, 10, or your own level. But at the minimum, coming up with your own rebalancing structure is critical, and then doing them regularly is also very important. So we talked a lot about the new concept of bond investing. So it's very important for us to get familiar with a lot of bond investing. They provide a lot of stability in regular income. They have risks associated with them as well, like any investments, but the main one is the interest rate risk. Other than that, they are much more less volatile than the stock market. So there are different types of bonds: municipal bonds, state, federal bonds, corporate bonds, etc. And if you're in a higher tax bracket, tax-free bonds probably is a better idea for you. When you have to select a bond, there's a lot of things you have to think about. And Vanguard has a very good PDF, a 10-page document on bond investing, which very simply summarizes a lot of things around a taxable bond, a tax-free bond, an open-ended bond, a closed-ended bond, a short-term bond, a long-term bond, a savings bond, a US bond, a state bond, which is a municipal bond with some tax benefits, corporate bonds, high yield bonds, saving deposits, convertible issues, call provisions, non-convertible preferred stocks, etc., etc., etc. Many different things to get familiar with. So there are three different risks in investments. The risk of the economy, on how the country does, the risk in stock selection, which company did you select or which bond did you select, and the third biggest risk is the human behavior or human misjudgment, the human psychology issues, which we talked about in the previous video with human misjudgment or the miswanting. That is something that we have to absolutely control with this fixed rule. It's like when we go to a shopping mall, we have a list of shopping things we want to buy, and we're only going to buy those. Similarly, when it's a 50-50 and it's time for rebalancing every 6 months, you will rebalance. If you stick to that rule, you're going to limit your human misjudgment errors because of emotional or intellectual issues. So in this chapter, in this video, we've answered multiple things. So two big things. Number one is how aggressive should one be as a defensive investor? We went through that. 50-50 is what's advised by Benjamin Graham himself. How and when should we buy and sell? Every 6 months, you should be rebalancing. You should be getting that back into that ratio. That automatically gets you to buying low, selling high, right? Should you be buying stocks because of a high dividend yield that the stock gives? No, that's not the only reason why you buy a stock. You buy a stock because of its company performance, because of a solid business, because of growth potential. So do not just go buy a stock because of high dividend. That's not the only metric that you look at. There are many websites like US News on the left. It'll give you a lot of municipal California long mutual funds. It'll give you the list of those. There's also this learn about bond investing, investor education through Vanguard, are really good resources to learn a little bit more about bond investing. Great, so happy rebalancing and happy avoiding human misjudgment. Thanks.